Session forward, what he feels where markets are headed, is it getting too hot to handle, and what is the big thing for the month of July? Pankaj, good morning. Thank you for joining us.
Good morning, Nikhil.
After a good May and a June, when markets in a sense were resilient irrespective of inflation, medical bad news, are we in for a subdued kind of second half? I mean, the first half belonged to the bulls. Second half, will it belong to the bears or will it be a draw?
If you look at last 1 year, broader markets have done extremely well. Small cap have given double of what Nifty has given, and mid cap has given 1.5 times of what Nifty has given. So clearly, we have seen very strong movement across stock markets. In our view, earnings delivery will be very crucial now, because from a valuation perspective, you take out any metric, you are trading above long-term averages. And this is on records that mid-cap index has given, 13-month non-stop positive return, which has never happened. Small cap index, 8 months consecutive. Last we saw in June 2004. So our sense is that over the next 6 to 8 months, we should see some consolidation. We also won't rule out a drawdown led by global markets. And we need to be a little careful at this stage. Though we acknowledge that we are at the start of the new profit cycle. Last year, we kind of bottomed at 2-decadal low at 1.6% profit to GDP ratio. This year, post-pandemic, despite of pandemic, we are at almost 2.6%. And if we were to factor in street expectation for FY22, we would land at 3.5-4% profit to GDP. So clearly, profit cycle is in our favor, but earnings delivery now becomes extremely crucial because markets are priced to perfection.
Ideas down 10%, the numbers were not all that encouraging. I don't know why markets always get tempted in buying into idea. I publicly stated that telecom is the business if you want to be with the leader, which are two, Reliance and Jio. Bharti is the pure play, Reliance is more like a hybrid. Pankaj, there are big IPOs which are planned in the month of July. One is Policy Bazaar, second is Zomato. These are large IPOs. These are companies which in a sense represent a sector where profit pool is not high, but the opportunity and the market caps are very high. How do you see market adjusting to this? One side, there is this entire rotation towards value. And on the other side, the IPO market is taking two companies public, which you cannot compare them with historical yardsticks like cash flow, P, or even margins.
A very good and interesting question. Actually, we are also thinking on those lines. That whenever these platform companies get listed, and a lot of them will get listed over the next few years, will the listed companies adjust themselves higher, or will the new IPOs adjust themselves lower, is the question we need to ask. And when we look at what's happening globally, I think there's a huge appetite for a lot of companies which are out of India, which are platform-based. And if you look at a couple of years back, almost it holds true right now also, that FIs own 40% of the free float. And they are hungry for such platform companies whenever they get listed and available in India. So our sense is that we have to go stock by stock. Not all companies will create wealth, but there will be many private companies which are getting listed, which will have huge opportunity to grow. Some of them have clearly proved their leadership in the sectors they operate in, though the cost economics still may be under question. But over the period of time, if market starts getting a sense that cost economics should be worked out, I think markets are willing to give a premium to them. So it will be interesting times, honestly speaking, to see whether the listed companies adjust themselves higher after the new age platform companies get listed, or it's the other way around. India has never seen large loss-making companies getting listed with such market caps. So it will be a new challenge for public market investors. Also, don't forget that most of these companies don't have a large promoter holding. And very soon they will be part of the index with good weightage. and hence ETF monies would be chasing. So there's a technical angle also attached to it. So we need to go company by company and evaluate each of them with an open mind. We can't be just closed in our approach that these are loss-making companies, they don't make ROE in the near term, and hence we should shrug off these companies at all. That will be our approach.
Portfolio, and you have a lot of exposure to home improvement. In fact, in one of your small cap schemes, you got Century Plywood and Sheela Foam. Are you excited about revival in real estate demand? What is the thought behind buying home improvement stocks?
So Nikunj, we believe that real estate is on a cusp, residential real estate is on the cusp of revival, and led by lower interest rates, led by subdued demand over the last 7-8 years, led by best affordability in last 2 decades. And clearly that is making us positive on the revival of the residential real estate cycle. When we look at the developer side, we are not too excited because if you look at over a cycle, most of the developers in India don't make ROE which covers your cost of capital, because a large portion of their capital is deployed in land banks which are not giving any returns. When we go one step lower, and there are about 200 industries which depend on real estate for their demand, you find some very exciting opportunities, and that's in the home improvement segment. Whether it be tiles, whether it be plywood, whether it be mattress, whether it be electrical consumer durables, whether it be wires, whether it be home lenders, mortgage lenders. I think there are some exciting opportunities there, and most of these companies, they may be classified as small cap, mid cap, but they are leaders in the segment. They operate at very high ROE. The cash flows and balance sheets are extremely strong and fit our investment philosophy. So yes, we are extremely positive on this space for the next 3 to 5 years. And we believe that demand, which has been subdued for last 4-5 years for this segment, should see a revival. And we see double-digit, top line growth for next 3 to 5 years coming through.
Sure. Pankaj, outside of the home improvement space, where is it that in this market and with the sectoral churn which is playing out, do you find more opportunities to bet on for the long haul?
So I think incremental our tilt is towards cyclicals, and in cyclicals we include industrials, capital goods, which will be both short and long cycle play, and financials. Just to speak on the other theme which we are positive on is capital goods and industrial cycle. Aisha and Nikunj, I think we are seeing early signs of this cycle coming back again. If you look at the corporate balance sheets, I think they have been best shape in the last 5-6 years. We were looking at some data, and across the board, corporates have delevered themselves very nicely. Look at metal sector. The total debt now is about 2,80,000 crores, and the annual cash flow of the metal sector is about 1,50,000 crores. Look at cement. The total debt of the top 6 players is about almost 10,000 crores. The annual cash flow is 25,000 crores. And similarly, in other sectors, we have seen significant deleveraging happen. And our belief is that once corporates start getting some sense on aggregate demand recovering, some confidence into the future, and with some uptick in inflation, I think they are getting excited for the next round of capex. We have started to see announcements happening across the board, and that's not local. I think that phenomena is happening globally now, that after almost a decade of subdued corporate private capex, we are seeing early signs of revival. And I think this sector is right now underowned. We may be in minority right now, but we are seeing early green shoots in the industrial and capital goods cycle.
When it comes to metals though, Pankaj, has the steep run up and now this off-late commodity correction which is taking place globally, does that not worry you, or do you think that the fortunes of metal companies back home are intact for the long haul?
I think this sector you have to approach on a short-term basis. I think the question everybody is asking is this a super cycle? In our view, we believe that a lot of demand and price uptick which we have seen is because the US consumers have spent a lot of money over the last 1 year on goods rather than services. Last 1.5, 2 months, as economies have started to unlock themselves, we have started to see that consumption of goods have started to taper down, and incremental services have started, and demand for services have started to move up, and that's kind of doesn't bode too well for metals. So maybe in a quarter or two, metals may do well, but over a longer haul, we believe that volatility will be far higher than one is expecting it right now. Also, secondly, you look at steel. Out of say $1 of global GDP growth, steel sector is now contributing 17 cents, which is quite high, which has not happened. Even on the profit pool side, look at Nifty. In FY22, 25% of incremental growth is expected to come from metal sector alone. So I think some of these data points clearly point out that we may not be at the start of the cycle, but towards the fag end of the pricing cycle at least. And we are taking a cautious approach on the sector.
Pankaj, what's the outlook on the rural recovery theme owing to the kind of policies that have been announced by the state and the central governments, as well as the overall monsoon factor? What are some of the stocks or sectors within this space that you'd like to bet on?
So rural, I think, may not see the same kind of recovery which we saw in the first phase. And the reason is that this time rural has also got impacted by COVID. And the vaccination pace there has been slow. Just to give you some data, as per our expectation, about 30% of the vaccination is done for tier 1 cities, but whereas for rural, it's about 13-14%. And that's something which probably is not good from a directional perspective. We need to get vaccinated as fast as possible for the entire country. And also the fact that the wave this time has hit the rural population in terms of discretionary spend. So the commentary coming out from most of the corporates after the fourth quarter number clearly suggested that the demand from rural has been slow. What has been positive for them is that the crop prices have been quite good across the board. Look at edible oils, look at sugarcane, look at some of the other crops like wheat, paddy, and the prices have been quite good. And if monsoon pans out as per expectation, which is normal and above normal, I think that's something which is a tailwind for the rural sector. But we need to keep in mind that the revival may not be V-shaped the way we saw in the first wave on the rural side.
You know, for the month gone by, it's been a bit rocky for the entire financial space. The Nifty Bank has posted its worst month since the month of March. What is it that you're advising one to do within the financials basket?
Actually, financials at this price point looking quite attractive. And the private sector banks especially, they have managed the crisis quite well in last 1 year. They have raised capital, balance sheets are looking quite strong. And we have seen consolidation across. Look at over the last 3 years, the big is getting bigger. The top 5 banks incremental market share in terms of lending is about 70% plus. They are better positioned on the capital adequacy ratio. And the fear of big NPAs is not materializing. So clearly, I think from a valuation perspective, financials, and after the underperformance, I think is a good space to be in for the next couple of years. But our positioning there is among the large private sector banks and maybe a couple of PSU banks on the banking side. Apart from the lending, we have non-financials, non-lending piece, which is insurance, general insurance, wealth, asset management, where I think there's a structural growth story to be played.
Pankaj, there are a lot of side themes which are popular now. ESG, EV. These are themes which are globally getting recognized. I was looking at S&P 500 and the S&P 500 energy index, and it's not gone anywhere. So do you think we are in more of the same, which is that energy stocks, coal companies, or even power companies which are thermal based, oil companies, they are likely to underperform, and ESG is going to get re-rated more and more? Because in India it's evident ITC is suddenly underperforming because nobody wants to buy it. NTPC is done nothing great because nobody wants to buy it.
Absolutely, Nikunj, you are bang on. I think this theme has got global recognition, both ESG and EV. And clearly we are seeing across the board, not only in India, globally, that the terminal value is getting challenged for a lot of companies, either based out of on fossil fuels or thermal power, and so on and so forth. So clearly, our approach towards is that clearly recognize this change which is happening and make sure that the portfolio is adjusted for disruption. The question is now when. It's not that whether it will happen. Some are saying by 2030, some are saying 2040, but the path towards that transition is clearly happening. And globally, if you talk to any company, they are talking about carbon footprint, decarbonization. And I think that's the big thing to go over the next decade or so. We are extremely cognizant that even if the near term is looking extremely good, we should be mindful of the terminal value. Because if you do a DCF of any company, 30, 40, 50% of the value comes in the next 10 years. But a large part of the value is in the terminal value for any company. And our sense is that if terminal value gets challenged over a period of time, it may be a value trap. And we have seen in the past, globally in 2015, you were looking at many of the E&P exploration companies, the giants, they looked 6, 7p. And 5, 6 years down the line, the E has just got evaporated and there's no P. So our sense is that we need to be really careful in recognizing the change in trends which are happening in front of us.
Pankaj, I'm saying something which every investor knows. There are two ways to invest. Either you play terminal value or you play duration. Just for the benefit of our viewers, you play terminal value, which is when you buy something cheap, and you play duration, which is that you say, look, I'm going to hold the stock. It could be an HDFC Bank or it could be an Asian Paints for many years because I'm playing time. Where are you playing duration and where are you investing based on terminal value?
So in terms of overall markets, we believe that our approach is more towards duration. We don't know that if the terminal value is challenged, markets will be too charitable in giving higher multiples to those companies. And we have seen time and again that many of the companies where the near term is also good in term form of earnings, but if the terminal value is challenged, I think there is a problem. Hence, our approach is that look at companies which are probably agnostic to this change. And in auto lines, we are finding many companies, for example, which are agnostic to IC engine or which are agnostic to, say, EV. For example, tires. You don't need a different tire for an EV or an IC engine. Similarly, on the power side, in the near term, thermal power plants may do well because there may be a mismatch of supply and demand. But over a longer periods of time, as more and more countries sign to the Paris Climate Convention, you would see that change being inevitable. And finally, renewals are taking over. The storage costs are coming down. And that's the big change we are seeing. And recently, auto battery manufacturer announced its plans for a gigafactory in India. And our sense is that over the next 3-5 years, you would see more and more corporates plunging into this, into this green mission. We saw the largest company of India announcing a $10 billion capital commitment, which is not small by any means. So our sense is that change is inevitable. we won't like to bet on companies where terminal value is challenged. We would like to play more for companies which have longevity and which can survive this change.
How do you see the pharma space adjusting? First, there was this entire COVID business rush, which a company like Cadila, or for that matter, Cipla, even Dr. Reddy is enjoying. These stocks have got re-rated. Do you see the COVID opportunity as a permanent line of business for some of the pharma companies? Do you see this, in a sense, this COVID crisis re-changing and recalibrating the business and the revenue lines for some of these pharma companies?
Absolutely, Neeraj. I think we are seeing stock-specific opportunities in pharma sector. Our thought process is like this. After every crisis, the sector which leads the crisis see massive changes, either in regulation or in terms of demand and supply. Look at what happened after 2008-9. It was led by financial institutions, and you saw a huge regulatory overhaul for banks, for insurance companies, pension funds, and so on and so forth. This has been a health crisis, and most of the countries has caught by surprise. Our sense is that COVID is not going away from us. We are not experts on that, but the way things looks like right now, some of the other variants keeps on coming, and the memories would be fresh for some time to come. And I don't think any country would take a chance in terms of inventory of medicines, inventory of important drugs. And I think there's a good opportunity for a large number of pharma companies. Also, we see that the new things like biosimilars, injectables, many Indian companies are making good progress on that, and the pipeline is looking good. So on a 3 to 5 year basis, we believe that there are decent opportunities in the Indian pharma space, but you have to go stock by stock. Though the COVID opportunity could be one time near term, but we are evaluating companies more on their pipeline over the next 3-5 years. And we are seeing some interesting opportunities there. So we believe that pharma is an interesting place to be in if one is looking at slightly longer term, but you need to be extremely stock specific. You can't paint the entire sector with the same brush, is our approach.
To have you in the show as always. Thanks for joining in.